What is going on, traders? As we discussed from our video a couple of days ago, this is gearing up to be the biggest week for 2022. What happens now will dictate what goes on politically and economically for the rest of the year. There are so many things to get into, so please bear with me here. We talked about a few of them briefly in that video from a couple days ago, but we will jump into them more in detail, and I will tell you how we're trading them as well, because there are some very lucrative trades here depending on what you think is going to happen. So I think the biggest development so far is how the White House is messaging what they think is going to happen with the GDP. Already they're trying to get out ahead of it, saying that the definition of GDP is outdated, and even if we get a negative Q2 GDP reading, that really won't be a recession. It might be a technical recession, and obviously they are getting technical here for political reasons, and every single party does this, every administration does this. Nobody wants a recession on their hand. But the fact that they are trying so hard to get out ahead of it, sending Janet Yellen out there, sending the White House Chief of Staff out there, already says that they probably know something about the severity of the GDP readings. Currently, the Federal Reserve Bank of Atlanta has an updated estimate for Q2 GDP at minus 1.6%. This was the same reading that we got for Q1. Now, obviously, that means that we have back-to-back negative GDP readings, which would officially put us in a recession if you're going by historical metrics of every single recession prior. Now, there is one thing about this recession, if it is going to be called a recession, that is actually an anomaly, and that is that unemployment figures are still very low at 3.6%. However, this is not as rare as one might think. If we take a look at Fred's economic data, you can see here that every gray bar represents a recession in previous history, and there are times when unemployment is historically low, and it starts to tick up just as a recession is announced, which could be the case here. So if the next unemployment numbers actually come in higher than 3.6% and the economy is declared to be in a recession, that actually won't be an anomaly. It won't be something that's very rare. We saw this in the 90s. We saw this in 2000. We even saw this in 2008 when unemployment was historically low and started to tick up right before a recession was declared. Now, remember, the GDP reading comes out on July 28th, conveniently after the FOMC meeting, which comes out on July 27th. So far, based on the Fed Fund futures, the Fed is expected to raise rates by 75 to 100 basis points. In my view, anything less than that or more than that will cause a shock, a temporary shock to the stock market, because the stock market hates one thing and one thing only, and that is uncertainty. As of the time of this recording, the US consumer confidence numbers came out, showing a decline for the third month in a row, which is why the stock market, partially why the stock market is down today. And we also have the PCE, or Personal Consumption Expenditures Price Index, coming out on Friday, July 29th. This is different from the CPI. This is actually the one that the Fed says they prefer to use. It includes a larger basket of goods and a larger number of households plus nonprofit institutions. And then lastly, this is the biggest earnings week of earnings season. We have Alphabet, Microsoft, Visa, McDonald's, we have Shopify, Meta, Ford, Qualcomm, Etsy, we have Amazon, Roku, Intel, ExxonMobil, Chevron, and of course, Apple, all reporting earnings this week. Now, of course, we'll be ready to play some of these earnings. In my view, there are some of these earnings that can actually be played by neutral strategy, something that we did similarly on Tesla last week. We opened up an iron condor on Tesla, and we just need Tesla to expire between 735 and 840 for 100% profits. Really anywhere in between there. This is the beauty of neutral strategies like an iron condor. Now, if we take a look at Microsoft's historical earnings, you will see that it rarely goes out of the expected range. The expected range here is denoted by these blue bars. In this case, I'm using Market Chameleon. And you could see that really only one time out of the last 12 times did Microsoft go outside of the expected range. For Microsoft's earnings, the expected range implies a 5.3% move up or down. So we can utilize an iron condor strategy for Microsoft as well, and we will likely do that. Another thing that caught my eye was, with all of these economic events, the VIX was relatively low at 24. The VIX is the volatility index, basically the fear gauge index, and this is based on how traders are trading S&P 500 options. Today, we ended up buying the $30 calls on the VIX, and we ended up 30% up throughout the day. I'm going to be holding these throughout these economic events because, as I said, the one thing that the market hates is uncertainty, and there's just too many of these events going on for the VIX to remain low. Now, obviously, There could be good news all across the board, whether it's positive GDP, good earnings, an expected Fed meeting move. However, with all of these things going on during the same week, I'm willing to bet the volatility might rise a bit. And again, we were already up 30% on these plays. We could have closed them out already. However, I opted to hold these for a much larger move and also to hedge against my portfolio. And this obviously is not even taking into account the options day trade watch list, where we killed it on QQQ and Tesla puts today, as well as Microsoft puts. We send this list out each and every single day. And you can see some of our recent wins here from the day trades, which can move very fast. For example, this triple Q's trade netted 215%. You could see the VIX trades that we talked about here, 32% today. A 500% trade on AMD. This actually wasn't one that I sent out, but one that the user took him or herself. So if you want access to the options course, the day trading course, you want access to the options day trade watch list, all of these alerts, my analysis, the chat with thousands of traders going over trades all day, every day, learning these complex strategies, sign up. Link is in the description below. Make an appointment with one of our ambassadors to apply to the Traveling Trader Academy. And if you make it in, I'll be happy to have you. And finally, we'll wrap up with one of Michael Burry's predictions regarding retailers. He predicted that retailers would suffer from supply bloat, meaning they would have too much supply and would have to slash the prices. And yesterday we got a business update from Walmart saying that they have to lower the profit outlook for Q2 and forward year 2023 because of this fact. So this is yet another sign that the economy is slowing because prices still remain very high. As a result, Walmart stock fell, as well as the stock of other retailers as well. And we could see a bullwhip effect, something that Michael Burry has also stated. This is where retailers, wholesalers, and manufacturers overreact to slight changes or an increase in demand, resulting in excess supply. Now, when they have excess supply, obviously they have to slash prices in order to remove that supply. Now, moreover, he predicted that this could be so bad that it would worsen the recession, because he expects there to be a recession for Q2 coming up in on July 28th. And it would further worsen or deepen the recession, thereby causing the Fed to potentially even pivot on monetary policy, meaning having the Fed actually cut rates instead of raise rates by the end of the year. So just to wrap everything up, Tuesday, Wednesday, Thursday, and Friday this week, we have the biggest companies reporting earnings. We have the GDP numbers coming out on July 28th. We have the FOMC Fed rate hikes coming up on July 27th. And on Friday, July 29th, we have the PCE readings as well. This is what makes predicting this week so hard, because what combination of these things have to be positive in order for the market to rally? And what combination of these things have to be negative in order for the market to tank? It's very unlikely that all of these things will be positive, or I think there's a much bigger likelihood that all of these things will be negative rather than positive. The only one being mostly priced in is the Fed rate hikes. And that's why I'm willing to bet on the volatility index rising at some point throughout this week. And I'm playing some neutral strategies on some of the mega cap stocks. Again, if you want access to that stuff, link is in the description below. Leave a comment down below. Let me know what you think is going to happen. I love hearing from all of you. I try to respond to each and every comment. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.